Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. So I came across this headline this week: 80 seconds of big tech earnings will decide stock market's fate. Now, I understand why journalists sensationalize headlines, but this is not helpful. Sure, much of the stock market rests on the strength of big tech earnings. And for the most part, the four that reported Wednesday and Apple on Thursday posted impressive results. Meta sold off because it is expecting to invest roughly 8% more than previous guidance in CapEx. Now, there was a time when investing more in something transformational would be a positive thing. As we've noted in our quarterly Forward Look publication, risk market valuations need the promise of AI to continue. For now, it looks like it is. This week, our three things are: 1. What we're watching, fresh off the press from our Forward Look publication. 2. Defaults two ways. We compare market prices to the bottoms-up view. And 3. Oil price perspective, getting past the threat of $100 oil. All right, let's dig a bit deeper. What we're watching. So each quarter we publish the Forward Look U.S. Credit Insights. In it, we highlight our macro forecasts, GDP growth, unemployment, one-year recession probability, and 10-year U.S. Treasury yield range, along with what we're watching and commentary around credit market valuation. So we've just published our Q2 version. What are we watching? Well, let's start with the obvious. Conflict in the Middle East, given its twists and turns in the news flow that clearly meets our test for geopolitical event relevance to risk assets, that it has the capacity to affect economic growth. In this case, global economic growth. That all comes, of course, from the conflict's impact on the price of commodities, energy, fertilizer, helium, etc., whatever moves through the strait. Now, we point out in the piece that it is important to define terms, in this case, where the economic threshold of pain exists relative to the price of oil. We cite Bloomberg economics research that says that $100 oil, the oft-cited threshold of pain, is more like $191 today. That takes the 2011 price of oil, around $100 a barrel, and adjusted it for two things: 1, inflation, and 2, increased energy efficiency, where it takes 25% less oil today in the U.S. to produce a unit of GDP than it did in 2011. That explains in part why investors have not sold off risk assets as a result of the conflict yet. While oil gets almost all the headlines today, we're also watching the impact of fertilizer disruption on food supply and price. That impact is less immediate, but no less politically charged. We're also watching inflation pressures, which are also impacted by the price of energy. Like tariff impacts, the extent to which these are inflationary as opposed to one-time price adjustments is debatable. But what we worry about are their impact on inflation expectations and second-order effects. The energy shock and ongoing tariff impact on prices come at a time when the economy is running relatively warm, in part due to the effects of 175 basis points of recent rate cuts and a fresh round of fiscal stimulus via the One Big Beautiful Bill tax relief. In addition, we're on the lookout for a round of additional stimulus under an affordability initiative as we head toward midterms. Few like inflation, certainly not bondholders. In addition to the aforementioned AI-related promise, we're also watching consumer spending. It's been remarkably resilient thanks in no small measure to a rash of COVID-era stimulus, which has helped to keep unemployment very low and wage gains above inflation. But headwinds are forming. The jobs market is softening, at least the likelihood of finding a new job. Wage gains are slowing, and affordability issues are weighing on sentiment. Look no further than the University of Michigan Survey of Consumer Sentiment, which just hit its lowest level in its 74-year history. Have a look. The Forward Look is available on our website, kbra.com. All right, on to our second thing: default outlook two ways. So commercial default rates have been well behaved now for quite some time. Why? Well, a big part of the story is that we are, in the U.S., in the midst of the longest post-World War II economic expansion, nearly 17 years if we exclude the 2 months at the outset of COVID. Now, we would point out that we've had a series of shocks along the way that have hit particular industries hard. Think energy firms roiled by the oil crash in 2014 and 15, or retail firms hit by the growth of e commerce in 2017 and 18. And we did see a rash of defaults pop up during COVID. So, a series of rolling industry specific shocks. But we haven't had a shock that has hit the economy broadside, an unemployment driven recession, since the GFC. Also at work here is something we spoke about last week: constructive pessimism, a behavioral overlay of financial conservatism that's guided both consumers and businesses over much of the past 17 years. That conservatism kept economic imbalances from happening largely because economic visibility has been somewhat limited over that extended time period. Now, jump ahead to today, and there's talk of a turn in the credit cycle. We're all aware of JP Morgan Chase CEO Jamie Dimon's credit cockroach warning and his more recent declaration that the next turn in the credit cycle will be worse than people expect. And, of course, the perceived vulnerability of software firms to an AI incursion has led many to call into question private credit underwriting standards. So, getting past the headlines, what are we seeing? Well, at KBRA, we have a look at defaults two ways: via pricing of deteriorated credits through our KBRA DLD data analytics platform, and via a bottoms up view of nearly 2,500 unique global middle market sponsored borrowers that we maintain coverage of as part of our private credit effort. On the DLD side, our own Eric Rosenthal estimates in 2026 the implied high yield bond default rate by volume will be 1.75%. Syndicated loans will be 3%, and direct lending, what is typically referred to as private credit, will come in at 2%. Those default rates are all below longer term averages, reflecting the relatively sound economy and abundant liquidity. On the KBRA platform covering private middle market firms, our KBRA Middle Market Default Monitor, or KMDM metric, consolidates borrowers identified as being in payment default or likely to be, absent ongoing interventions or concessions. At March 31st, the KMDM was 2.2% by volume. To bring us fully up to date, KBRA's deep dive into software and technology firm financial condition recently reviewed some 495 such firms in our coverage universe. You can find our related research on our website, kbra.com. KBRA identified firms with near term maturities that are particularly vulnerable to AI, represented an additional $9.1 billion of volume that would bring an illustrative KMDM to a still reasonable 3.1%. All right, on to our third thing: oil price perspective. Now, following on our discussion about $100 oil and how a more relevant threshold is more likely to be $191, we came across two additional perspectives on oil prices that we found useful. The first, coming from Bloomberg, shows data on 7 past oil price spikes. The chart shows real price change, low to high, and WTI in the 6 episodes, excluding the current spike, ranged from 122% to 433%, with most coming in around 150%. Now, since the current conflict began, WTI is but 56% higher, meaning the shock so far has been not all that shocking. From our perspective, $150 a barrel for several months begins to leave a more material mark on the economy. And for what it's worth, 150% of the low point in this conflict of $67 a barrel would jump that number up to $168 a barrel. We also saw a chart from Bloomberg Economics tracking oil prices in 2024 US dollars over the past 56 years through Middle East wars. In 2024 dollars, the price of oil today is about average. The price was higher during the US Iran crisis in 2020, higher for an extended period, 2011 to 2014, post the Arab Spring, much higher during the US surge phase of the US Iraq War, and during the start of the Iran Iraq War in the early 1980s. The period of 2011 to 2014 is an interesting time frame. The price of oil, again in 2024 dollars, was about $100 to $140 a barrel, yet economic growth in the US was right around 2%, and stocks moved up around 60% over that 3.5 year period, and public investment grade credit spreads tightened 50 basis points, well below the long term average. The point is, context matters. Are we coming out of an economic doldrums, as was the case in 2013? Is there some structural move in supply or demand coming into play? History tells us markets look past dislocations. So there you have it. Three things in credit. One, what we're watching. Our Forward Look publication lists inflation and commodity price pressures, the strength of consumer spending, and the promise of AI as key concerns. Two, defaults two ways. Market pricing and a bottoms-up view suggest we are not looking at a turn in the credit cycle. And three, oil price perspective. It's important to understand the broader context when thinking through the impact of higher oil. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research, including my Forward Look, my European counterpart Gordon Kerr's Forward Look, and KBRA's Q1 2026 Middle Market Compendium. We'll see you next week.